Devin Anderson is an intentional investor out now on Epsilon Theory YouTube. You are going to love this. We talked about working at a startup while you're still in high school in the 90s, tech bubble, timesheet scams. This is a giant story here. And we talked about what it's like to be in a bad bank. That's right. He worked at the bad bank at Deutsche Bank. You hear about unwinding all that stuff, being one of the last guys to shut the lights out on the way out, all the way to going to Convexitas, where now he's running a good startup. Jack Forehand, roll some clips.
I was in a computer lab. The teacher who owned the computer lab was out sick or whatever, not there that day. And the substitute teacher happened to be the fiance of an internet startup in Pittsburgh called Stargate, which was just launching dial-up internet. And that day, like there was some issue like in that computer lab, and they went and got me. And like I came and like fixed it. And then like went back to my class. She's like, "Who's that kid?" And so she comes and gets me and she's like, "Listen, my fiance's starting this company. You should talk to him." I didn't even have a driver's license. Like I was taking my driver's license test the next week. One day the elevator door opens and like 4 FBI agents come out of the elevator and they're like, "We need to talk to whoever's in charge here." And it turns out that the company that we bought had a contract with the state of West Virginia where the employees of the company had engaged in this timesheet scam. So we were just being asked to cooperate. But like literally the internet bubble is bursting. Revenue on all this stuff is going to zero. The FBI shows up. I mean, it's basically a trading desk on its head where instead of trying to facilitate trades, you're trying to get rid of trades. You literally get to the point where there are no more trades, right? And then your time in the bad bank is done. Then there was 3 more people that stayed longer than I did. But I mean, I'm actually just coincidentally, I'm going to see the guy that like literally turned the lights out. I mean, that old joke, turn the lights out on your way out. The guy that literally turned the lights out. I think entrepreneurs are a little too casual with what that means. So these people that work for you, okay, there's a lot of reasons why they work for you instead of having their own business or doing something, right? Or working in a big company, right? You have a responsibility to the people that work for you. And I think that gets lost kind of on a couple dimensions. I think to the entrepreneurs, you get used to a certain level of risk and you kind of forget that maybe the people that work for you aren't signed up for that level of risk.
Welcome to The Intentional Investor with Matt Zeigler, where he and his guests explore the intersection of investing and life, portfolio and purpose. Nothing in this podcast is investment advice. Nothing in this podcast is advising you to buy or sell any security or to do anything with your money. Seriously, you should only act on investment advice from someone you know and who knows your unique situation. We are not that person. Matt Zeigler is a managing director at Sunpoint Investments, and the opinions expressed on this show do not necessarily reflect the opinions of Sunpoint Investments or of Second Foundation Partners. Securities discussed in the podcast may be holdings of Sunpoint Investments.
You're watching The Intentional Investor right here on Epsilon Theory YouTube. I'm Matt Zeigler, and this guest today, life sometimes, it gets you down. It gets you in the pits. And yes, that's a Pittsburgh, Pennsylvania dig. I'm going there, but I'm not going to go full Pittsburgh on this intro, so relax on that one. I'm going for another small city where I don't think this guest has any relation, but I'm taking us to Baltimore. Okay, any Baltimore? Can I ask any Baltimore before I run into this? Any love for the city of Baltimore? Perfect.
I don't love the traffic in Baltimore, I can tell you.
Well, let me say, this guest is the Harris Glenn Milstead of finance, partly because he's 1 letter short and a 2nd letter off in his first name of being not Devin, but Divine. So why would I call him the Divine of finance? Not because all his life he wanted to look like Elizabeth Taylor and now Elizabeth Taylor looks like him, although that'd be odd if true, especially considering she's since passed, but because he uniquely understands how risk-based management rather than rules-based approaches can help make options not just a drag on performance, or as he does it all today, by managing convexity. As the Divine once put it, my favorite part of dressing in drag is getting out of it. Drag is my work clothes. Well, options drag are his work clothes too. And in one way or another, even John Waters would probably agree he's the most wonderful options expert in the world, almost. He's got a backstory that I never hear him covered when he's on other podcasts, so that's why I had to have him here today. I think I can still talk. It's late in the day. And He's Convexy and he knows it, or at least he's the CEO and co-founder of Convexitas and he knows that. The always divine Mr. Devin Anderson. Welcome to The Intentional Investor.
Thank you, Eric. Thank you very much. I mean, all of your guests say how they anticipate and are not disappointed by the introductions. And all I can say is I highly anticipated it and I am not disappointed.
Well, we took it all the way to John Waters in Baltimore and cross-dressing. So I hope that sets the stage.
That's cool. I mean, we could have done some like real Pittsburgh yinzer, yins ain't going down no bounty hours. So,
hey, listen, I got 2-3 things to teach you about the other side of the state here. Okay, you guys. Yeah.
Whoa, where did that come from? You know yinzer?
Oh, we know all about the yinzer over here on the eastern side of the state too. So,
wow, did you eat yet?
I'm taking it all the way back. I'm starting right here because I could derail us with Pennsylvania talk all the way through. Did you grow up in Pittsburgh? Are you Pittsburgh born and raised?
I did. I did. The whole part of my backstory involving when I worked in technology occurs in Pittsburgh, up there in that.
All right. So first off, Pittsburgh proper. Where are you actually living when you're a kid?
I grew up in the South Hills. I actually went to South Park High School. So, the show South Park, they named it because there's a South Park in every state. Well, I grew up in the South Park of Pennsylvania. I went to South Park High School, and then I lived and worked in the North Hills and in the city. So the suburbs, and then driving into the city every day for a job. But it's not like driving in New York City. Let's be clear. You get to be in the city in 25 minutes in rush hour traffic. So
right, slightly better traffic than Baltimore too, to say the least. Okay, what are mom and dad doing? What's the family situation like?
So I was the first man in my family not to work in a construction or tangential to the construction business job. I didn't really have an interest. My mother was a nurse. Which was kind of interesting. She went to nursing school after my parents got divorced. And I used to go to classes with her as like a 6 and 8-year-old. So I have all this like random medical knowledge that I just sit in class with her, right? Like she was like, "Oh, we don't need a babysitter. You're coming with me." I'm going. so that's kind of weird. But yeah, mom was a nurse and my father's a construction executive.
What kind of construction? Like commercial, residential?
Yeah. So buildings that you would know, like I remember when I would go visit my dad on weekends, we would go visit Liberty Center in Pittsburgh, which at that time was, this was 1986, 1987. So not complete, that's now where Federated Investors is in downtown Pittsburgh. So that type of commercial work.
That's awesome. And siblings? Who'd you grow up with?
I'm an only child. Though I have 2 half brothers who are, 16 plus years younger than from my father's second marriage. So it's a weird thing. Like they don't think I'm an adult, even though I'm pretty size.
It's funny how that works. There's a relative value adjustment that has to happen in those situations where it just never translates, right?
Yes, that's exactly right. But effectively, so I actually, from a sale, I've had a lot of sales jobs, and I'm a student of the great David Sandler, who placed a great emphasis on birth order. And you can tell a lot, I think, about people from their birth order. And once I get to know people a little bit, I like to go around a table and guess people's birth order based on what I know about them. But like I'm a holy crap only child. But what he says is that even if you have siblings, if you're more than 6 years apart, it resets. So even if you have a sibling and they're if there's 6 years between the two of you, the next one's still in a win.
Yeah, it's interesting. I have a cousin that work very close with her and her family, and they've got an age gap between 4 kids. And in that age gap, it's like there's the bigs with their own dynamic and the littles with their dynamic, and then they have a cross dynamic. And you have to reset everything. It's really funny.
Yes.
Plus 2 babies of the family always makes things interesting. Yep. Okay, so what are you into as a kid? Like besides eating good Pittsburgh food, French fries where they don't belong.
It's funny that you say that. When I got a car when I turned 16, the first place I went was for Mandy's in the Strip District.
You're making
I
6 people happy, but they
I
are
love.
so happy right now.
Yeah, I know. I love those things. Tony, I mean, she's an angel. I mean, anyway, no. So I was super into computers. Um, I was given a 4 color, actually a monochrome color monitor, like a X86. This was back when you put 5.25 inch discs, DOS discs into the computer to boot it, right? Like you couldn't even, there were no hard drives in the computers
Yeah.
yet at this
You had
point.
to do the DOS prompt to even get the thing to load up off the disk.
Yeah. If
Good
you wanted to
times.
start Windows, you typed Win32, right?
Right.
But anyway, so I started kind of all the way back there and super into that as a kid, which features heavily in the path that I end up, the very odd path that I end up taking to Wall Street. But that, and I was a swimmer and a Boy Scout. Boy Scout is much different now than when I was a kid, but I would say at that time, an amazing program and exposure to stuff. But
What level? Are you an Eagle Scout? What level did you get?
I will tell you, I don't have a lot of regrets in my life, but one of them was not completing the Eagle Scout. I went all the way to like one before that, and I got it right around that time, like when I really would have done it, was also the time that I get my first job, which I think we'll talk about. And for reasons that will become obvious, I was much more focused on that than the Eagle Scout thing. It's not like I wasn't warned. They told me, get this done before you turn 16 and like want to go on dates and have money and have a car. Okay. And I did it. And then all those things happened.
And you did it again.
I did it. But I actually did a lot of other things. There's kind of a sub part of scouting called Order of the Arrow that I had relatively senior leadership positions in, and at the council level. And then there was a absolutely marvelous leadership training program that I participated in and then was on the staff of for many years. So there was actually kind of other parts of scouting that I went pretty deep in, but regrettably I did not finish the Eagle Scout. But it's okay. I made it.
We won't pick on you too much for missing out on that. So what's the job? What happens when you're 16 and all of a sudden you're distracted?
So I had spent by that point 6 years messing around with computers and was pretty literate. Now this is 1996. Okay. So just to put that in context for, people that haven't been around, 1996 is essentially still pre-internet, although there is internet. All right. But the internet that exists is like the Netscape browser with the pulsing end, right? If you can go back that far, Yahoo was just starting. There certainly was no Google, right? Yahoo was just starting, and it was a manually curated list of stuff. Like people made lists of websites at that, manually, no AI, no crawlers, nothing like that. The AOL and CompuServe was still mailing out CDs, and you dialed up to the internet. So you either had a regional internet provider, you loaded up the AOL or CompuServe disk, and you called into one of their phone numbers to get on the internet. But a modem tied up the phone line in your house to get on the internet at this. So I was working on, and I was in a computer lab. The teacher who owned the computer lab was out sick or whatever, not there that day. And the substitute teacher happened to be the fiance of an internet startup in Pittsburgh called Stargate, which was just launching dial-up internet. And she sees me, and that day, like there was some issue like in that computer lab, and they went and got me, and like I came and like fixed it, and then like went back to my class. And so Erin was her name. She's like, "Who's that kid?" Right. And so she comes and gets me, and she's like, "Listen, my fiance's starting this company. You should talk to him." Okay. Like in that conversation, I didn't even have a driver's license. Like I was taking my driver's license test the next week. Okay. So I do that. And then after I went to Permanis, the first real thing I went to is I drove out to this job interview. And they were like, "Whatever, like you're fine. Come in when you can, after school, weekends, whatever, report to this guy, we'll pay you minimum wage. And if you're useful, we'll keep you around. Like that was like literally the deal. Right. Well, it turned out that I was useful, and I worked there from 1996 to 1999, doing kind of networking stuff. You dial up to the internet, mail servers, web servers, kind of running a dial-up regional internet service provider. I did that for a while. Then the guy that I worked for went and worked at Lycos, if you remember Lycos, the search engine.
Yeah.
Okay. So, at that time now.
When I don't ask Jeeves, I asked Lycos.
Yeah.
Or
so
Prodigy.
Ask Jeeves, Alta Vista, Tripod, that era. Again, still pre-Google. So Lycos was number 2 to Yahoo at that time. So I got this opportunity to go work at Lycos. So I go work at Lycos for 2 years. And if you went to any of the Lycos properties between 1999 and 2001, early 2001, I guess, that was a production network that I was running basically as an 18, 19-year-old. And I was going to college at that time, by that point, obviously. And I was going to the University of Pittsburgh. So I would go to class and then get on a bus and go downtown. Lycos's office was, the technical offices and the servers and all the equipment were still in Pittsburgh at that time, because the original search engine was licensed from Carnegie Mellon. So they kept it in Pittsburgh. The executive offices were in Boston because CMGI was funding Lycos at that point. So I do that for a couple of years, still in the technology world. Eventually they decided they want to move everybody to Boston. I'm halfway through my degree at the University of Pittsburgh. I'm paying for it myself. I tried to transfer. I would have lost half my credits. I was like, not doing that. It's amazing how incentivized you are around that stuff when you're the one writing the check, right? So I decided not to do that. And I go back to the place I was working at the first time. But by this point, they're now they've got a dial-up internet service business. There's other technologies like cable and DSL. So they've got this residential internet business. They had purchased, while I was gone, a commercial internet business called USA On-Ramp that was relatively successful. And they were launching a data center business. And the reason I came back is that when I was at Lycos, we were the biggest client. Do you remember a company called Exodus? Was eventually bought by like WorldCom or one of the telephone companies. But it was a data center. It was the original kind of standalone data center hosting business. Lycos was Exodus's second or third biggest client. So I kind of knew that business from a technical standpoint, inside and out. So I came back to start a data center business at Stargate in Pittsburgh, doing networking, creating product. I did that for a while. And then eventually we got that stable and realized, well, what we really need is someone to go out and talk to clients. So I kind of slowly, over a period of a few years, become a salesperson. First is just like a technical engineer, and then, I guess after the big event, which I'll talk about next, I actually become a standalone salesperson. But
okay, wait. Time out a second.
Big thing happens, though.
Hold on to the big thing for a second, because so number one, what's the college degree in? What do you go to college for?
Business administration.
Okay, so you get business administration for college. You're doing this work all through the college experience. Does this mean
I don't really have a traditional college experience?
Yeah.
I worked and I went to school and worked. That's what I did. And I was happy doing it. I'm not antisocial, but I was really excited by, I was working at second biggest website in the world, right? It was awesome. So.
And how conscientious are you at the time of you're working on, the vanguard of life as we know it today? Like, are you like, this is the future and I am in the future?
Yeah. At that point, I thought I was going to spend a career as a technologist.
Right.
Right. And someday I would have some idea, and I would have my own technology company. But I was really bought into the internet, what was possible, and how fast things were evolving in the early 2000s. Now, still pre-bubble bursting. I should point out. So we're talking like Pets.com height, right? Like grand stupidness of people making, as Jared Dillian says, people making money out of proportion to their skill and knowledge.
Okay, now Now take us to the event that you're teasing me with here.
Yeah. So I'm back at this place because I couldn't move to Boston. And we've got this data center business. We bought an old insurance, Highmark, the insurance company, bought an old data center from them, fit it out, start selling product. And the venture capital guys come to us and they say, you know what you really need, right? You've got this commercial internet business. You've got a residential internet business. You've got a data center business, a fledgling data center business. What you really need is now a software development capability so you can write software, develop software, put it in your data center, and then use the infrastructure to deliver it. Like it's like there's network effects here among all this stuff. It's a great sounding VC pitch, isn't it? Right? Like, yeah.
You just got to cross the chasm, Devin. If you could just cross this chasm.
And you can tell from my grinning how it's going to end.
Oh, yeah.
So there's VCs on the board. They didn't have a majority seat, but they convinced the board and ultimately the management that this was the strategic direction. So they they get a syndicated loan from 3 banks led by Fleet on a revolver. Okay. And one of the terms of the revolver is that you can borrow the maximum drawdown on the revolver was a ratio to your EBITDA. All right. Now that started at some number like 8 times or 6 times or so. I don't remember exactly. Okay. But, I said, this is starting to look like 2001, 2002, like things are starting to sell. Right. So they buy this thing, and I'm not going to say the name of the company because like things start to happen, but I'm not going to say the name of the company. I don't want to get into specific numbers, but, not significant millions of dollars was spent on buying this thing. And then, so they buy it, and then the internet bubble starts to burst. And what's happened? Like, well, this company primarily did deliverable-based software work, meaning you hire them to write a project, and then the client owns the intellectual property at the end of the project. Now, you might be saying, but wait a minute, I thought you were buying this because the software was going to run in your data center. Yeah. Okay. And this is why you don't trust venture capital people, is because they don't actually think through all the details, right? The skill of doing project deliverable software work is not the same skill as building software that can be scaled in managed services. Okay. Those are 2 very different things, right? So the vision was to build AWS before AWS existed. Like I don't say that now with hindsight. Like we had shared managed services. Like we were taking equipment from Cisco and EMC, the disk company, and other technology companies. We were taking that stuff that was meant to be sold to one person, and through kind of our own ingenuity, virtualizing it to be sold to many people. We were doing that in 2000, right? And this is way before modern cloud computing and software-defined networking and all the tools that we have now. So we were doing that on kind of the network and infrastructure side. But the idea that you were going to like develop apps with this group of people that had only done project work, like I look back on it now and I'm just like, of course this didn't work. But that wasn't even the problem. The bubble was bursting. So all of the project-based work that they had is just like plummeting to zero. Okay. So you buy this thing on a revolver that is tied to the EBITDA of the overall firm. The revenue contribution from the thing you just bought is cratering. And literally one day, so we had this office, and there was like no door, like the elevator would open, you just walk right into the office. I'm not kidding you. One day the elevator door opens and like 4 FBI agents come out of the elevator, and they're like, we need to talk to whoever's in charge here. And it turns out that the company that we bought had a contract with the state of West Virginia where the employees of the company had engaged in this, which people were convicted of, had engaged in timesheet scam. Okay, so they're defrauding the state of West Virginia. Now, it wasn't us, right? That contract, as I understand it, was actually never assigned to the firm that I work for. And it didn't come along with the purchase. So we were just being asked to cooperate, right? But like literally, the internet bubble is bursting. Revenue on all this stuff is going to zero. The FBI shows up. I mean, not for us, for somebody else, but just, as a cherry on the top. And kind of the whole thing comes crashing down. Okay. Now here's the next important lesson. We're a bunch of guys from Pittsburgh. Okay. So when it becomes apparent that we're now going to go into technical default on the revolver, but we can still pay, okay? Because the internet business and the data center businesses were cash flow positive. So what do? Pittsburgh guys were like, oh, well, Pittsburgh guys, we pay our debts, okay? So we call up the bank, and over the course of the next 2 years, negotiate several rounds of forbearance, okay? So like, we give them warrants, and then they give us a pass on the covenants. And, this goes back and forth for like 2.5 years of multiple rounds of forbearance, right? Well, one day, it's now 2003, okay? And the syndicate of banks goes, no mas, we want assets. And they move for the assets, we have to file for bankruptcy. And this is the second lesson that I learned really early, that I learned from this experience, which is when you borrow money from a loan portfolio, okay? Be the first to default, not the last, right? Because the reason that they wanted the assets is because we were the only thing left, right? We thought we were doing the right thing. Like, hey, we can pay. We're going to pay. We're in technical default on this covenant. We'll negotiate it around and we'll keep paying. Yeah, that wasn't the right thing to do. The right thing to do was just slam the bankruptcy right up front, right? And negotiated when we still had some, when the rest of Fleet's portfolio and the syndicate was still had value, right? But then when you get to the point that you're the only thing left of value, right? Then they just want assets. So the business ends up going into a structured sale and gets sold off. The commercial internet business got sold off. The residential internet business got sold off. The data center business got sold off. And the software thing wasn't worth as much anymore, also got sold off. So it kind of got sold in pieces. But right when the bankruptcy happened, I looked around and went, I need a plan here. So I made a deal with the leadership. I said, look, people are going to blow out of here, right? Like a lot of people aren't going to stick around. I was like, but I will stick around if you just give me the flexibility to go to business school during the day. Not full-time during the day, but I'm going to have to go at least some during the day. And they were like, yeah, whatever, fine, right?
So, you've done this before too with some of these guys. So they're like, yeah, you've always been in school. Because you're how old at this point?
I would have been 24 at this point.
Right.
24. No, it's 24, 25.
Okay.
So, and they're like, yeah, whatever, do what you got to do. I remember we declared bankruptcy like the day of or like a day after tax day that year. So it was April. Okay. The last round of admissions at Carnegie Mellon were due on April 30th. So I decide I'm going to business school 2 weeks before applications are due. So basically in 2 weeks, I put my business school application together, got all the references and took the GMAT. I did all of it in 2 weeks. It was, all I did for 2 weeks was get that together. And I get in remarkably. Although I got into the flex time program, not the full-time program. As I look back, I'm not sure that my half-ass application would have gotten me into the full-time program that I put together in 2 weeks, but I snuck in the flex time door at Carnegie Mellon. And then I did that for a long time. It took me 3 years to graduate because I did the first half of it part-time. And that's where I found derivatives. So I took some financial derivative modeling classes. They were like, hey, you're kind of good at this. You should talk to some banks. So I went to the presentations. And at this time, banks still recruited associates. You could get hired as an associate rather than an analyst, right? With a graduate degree. Now that isn't a thing. Banks hire far fewer numbers and almost exclusively analysts because they're cheaper and they figured out that the associates don't really add that much more value than the analysts do. So at that time, you could come in as an associate. So I end up getting the job at Deutsche Bank, or I get an internship at Deutsche Bank. So I do an internship as like a 27-year-old, right? Instead of a, as a late 20 something instead of an early 20 something, which was slightly weird, but whatever. And then I got the job and I ended up being at Deutsche Bank for 15 years until that business failed, right? Deutsche Bank shut down all of its equity businesses. And then I was in the bad bank for 18 months, shutting down the things and auctioning off the things they used to run.
We're going to go through bad bank. I'm going to ask you about bad bank, but hold on. I want to go back to, I want to go back to this.
Bad banks are amazing. Yes.
First off, in the MBA program, they figure out, you figure out, you're good at derivatives. Is this just programming brain gets exposed to this stuff and goes, this is intuitive to me? Is there a computer layer to how'd that happen? Because it's not normal.
Yeah. I mean, I was interested in derivative pricing because
why? Who says that? Why?
Because I just saw that I look at the screen and there's options there, and I'm like, what are these things and where do these prices come? Right? And like, what model do you use? Like, what shared psychopathy do people have that they believe that they can come up with, value for these things? Because it looks like dark magic to the uninitiated, right? And I had to take electives, right? So I'm like, okay, well, when I was an undergraduate, I needed electives. I took basically all the psychology courses I could that didn't involve a rat lab, okay? Because I didn't want to do the rat lab because you didn't get credit for it. So I was like, I'm not doing it. But I was fascinated with the subject, right? Well, as a graduate, I was like, all right, well, I'm going to take these finance courses and I'll take some derivative pricing. I find this guy, Dwayne Seppi, who's amazing. We're in touch to this day. And I kind of just fell in love with the subject matter, the idea that, you can take statistics, randomness, and you can wrap some calculus around it. And you can say, through this notion of a risk neutral probability, I can, or I should say a risk neutral state price, I can come up with a price for these options and expectation. That was a fascinating thing. And then, then I started talking to bankers and then went and visited some banks and sat on the trading desk. And then I saw the trading desk culture, right? And I was like, this is what I want. Because I had just come from the technology world, which wasn't button up, stiff, but it was a corporate world, right? And I was like, wait a minute, are you telling me I get to do the cool applied math in this environment that, was basically like a locker room, right? And that was super appealing to me, right? And by that point, what I skipped over was after we came out of bankruptcy, I actually stayed on with one of the companies that bought the internet business. But at first they weren't going to do that. They were like, no, we're done with you. We don't need you anymore. And the founder was like, you're only working part-time. Why don't you just be a sales guy? He's like, you've been you've been holding the hands of salespeople for the last few years. He's like, just go be a sales guy, have a quota, whatever. Right. He's like, if it doesn't work out. They're going to fire you anyway. And I was like, all right. So I end up being this pretty successful sales guy selling internet access and data center stuff, which was useful when I came to Wall Street because I was like, look, I do math and I talk to strangers. I do both.
A rare combo, if ever there was one. Yeah.
So, that really worked out. So that, also I skipped, when I was talking about lessons learned about the whole, be first to default thing, I think when you combine the be first to default lesson with the don't listen to VC lesson, I'll show you. I keep on my desk. I was an equity owner of the business too. I keep on my desk a framed stock certificate. This was not a public company. These were private shares. I mean, this is literally not worth the paper it's printed on. But I keep that on my desk over here as a reminder of where, this is a very serious thing, of where value comes from, right? Value doesn't come from a bunch of guys that think that they can buy companies and stick them together and tell people a story. You can get away with that right? but ultimately value comes from cash flow from operations. And it's really important, I think, as an entrepreneur, now I own my own business, not to lose focus on that. And I feel like I might be drifting away from what you want to talk about now, but I feel like there's kind of two ways anymore to start a business. There's, what we're doing at Convexitas, which is like we put our own capital in and we're really careful and we're super prudent and we manage every line and how to grow responsibly. And we were cash flow positive, after 14 months, and, like we automate the hell out of stuff. And, every time we hire someone to do something, we actually expect that they do it or we fire them. Just kind of diligence, right? The other but what I don't have is a lot of employees and fancy investors, right? And sometimes people want to do diligence by a lot of employees and having fancy investors, right? And so sometimes I feel like, the other way to start a business is, well, we should have told a great story, raised a bunch of money, hired a bunch of people, and just hope that the fission reactor start, right? And that's a different way to go, but that's also how you end up with those stock certificates. So, not that Stargate was all that. It wasn't. There was very thoughtful, good people running that business that, unfortunately, one levered decision at the wrong time, encouraged by some venture capital guys, put the firm in a place where, ultimately it could no longer negotiate the forbearance that, as I jokingly said, probably never should have been negotiated in the first place. But I just think it's such an important lesson that I learned through that experience. And I think now, Sir Zed and Zed Francis, my co-founder, and I very well that, you're not going to do you're not going to do due diligence on Convexitas by asking us how many employees we have, or where our financial backing is coming from. That's not an exciting story. We have 4 employees, a whole lot of code that I think does the job of another 4 employees. And the money is mine and Zed's. There wasn't any outside, stamp of approval from, kind of fancy investors. But anyway, I realized that was a bit of a divergence and maybe a little bit of my hobby horse, but
it's important because you're triangulating back on, and I'm going to force you to do this later on anyway, is just triangulate some of the stuff from today back on then. Another question that I have, and then I want to go back to the Deutsche Bank and the trading desk days and all this stuff too, is as you're learning derivatives and you're learning option pricing and you're learning this stuff, are you looking back on what just happened in the internet bubble and asking questions about, I'm curious about this. This is something Chris Abdelmasih just was telling me about this in his experience the other day, where, a bunch of the people he was working with, I can't remember if I don't think he was at SIG yet, but he was going, they all looked at the option stuff and were like, well, the market told you this could happen. Here's the Amazon option prices telling you the 95% drawdown is coming. It was all there. Why is anybody surprised?
Yeah, I think the people at the bank looked at me as this strangely skeptical young person, right? They're like, why are you so, so I was at Deutsche Bank long enough to see 2 SPAC cycles.
Oh God. Say no more.
Right? I mean, and as an ex-internet guy, as a guy who had a front row seat, and by the way, that stock certificate, that wasn't given to me. I mean, I wrote a check for that thing.
Right.
I learned that lesson the hard way.
Paid in, baby.
Right. Yeah, exactly. So, as a guy that's had that experience, you look at that and go, I don't know about that. Right. So I was probably a little bit, if I'm honest, I was probably a little bit of a pain in the ass sometimes. Right. Cause I just feel like, I don't get it. Right. I was just a little less willing to just accept the narrative handed to me. Which I think would have been, I could have never been a cash salesperson or research salesperson in equities. Right. They just would have been you're way too much of a pain in the ass, get out here. But I got away with it in derivatives because we weren't necessarily selling the stories that the bank wanted us to sell. It was much more about technical aspects of the derivatives market, which was the stuff that I was interested in, right? And when I started off the bank as a derivatives salesperson covering volatility arbitrage accounts, so like the technical end of the client spectrum, and then I later added on the asset managers as my focus. So like I was never in like the narrative driven story part of the trading desk. I wasn't covering macro accounts. Okay. Like those guys, man, those guys love a story. Those client dinners sound a whole lot different than mine. Let me tell you. Not there's anything wrong with it. Right. It's just, it's a different thing.
Yeah.
So, yeah, I kind of came at the whole thing, I think very informed from, watching, an internet company, implode from the inside. And I was also, later on, like in the late stages of Deutsche Bank, I was a little bit more likely to rage against the machine, I think, because I'd kind of seen, right, already this happen at another company. And I get told stuff like, well, it is what it is, or, we have to focus on the things that we can change. And I'm like, that's what I would get told. Right. And I'd be like, well, I mean, okay, but eventually, right, if you don't pick a few things to push back on, like you lose control of the business. Right.
Yeah.
And, Deutsche Bank shutting down global equities is, a much broader and nuanced conversation than just that. But, I do think those experiences, made me, kind of question and just not accept the prevailing narrative quite so easily. In fact, I think at one point, I'll say his name because he's not going to care. At one point, I had like 11 bosses over my time at Deutsche Bank. I had a lot of bosses. One of them is this guy, David Silver, who I'm in touch with. I love the guy. I'm pretty sure he still won't admit it to this day. I'm pretty sure he wanted to fire me in by the third time, right? Because he was like, this guy is just not going to go along easily. Now we turned out to be great friends, but I think if Dave were honest, he would have been like, we got to get rid of this guy.
He's not helping the cause. All right.
Well, I wasn't easily accepting and spreading the narratives, right?
Yeah, because that's part of being in a big corporate culture. You have to be a messenger of these things in the right way.
Well, and by that point, I was a more senior person, right? Mm-hmm. So, but I was a big producer, right? The clients love. Yeah, I think I probably was a lot closer to getting the axe more than I realized. But whatever, I made it to the end. There was a very specific end, which is also unusual in investment banking context.
Okay. Financial crisis period first. What's that like for you? What's 7, 8, 9? What's the experience in the world that you're living in there? Especially at Deutsche Bank.
Okay. So another name that he won't mind being mentioned. One of my earliest mentors in this business is a guy named Ed Corey. And I remember it was very specifically, it was March of 2009. Okay, so this is like the height of it, right?
Yeah, that's the low, right? Beginning of March.
Well, yeah, the height of the volatility.
That's what I mean. Like
the market, yeah,
doesn't get more volatile than that.
I mean, this is like the market is moving 2% before the open every day, right? Like you just. It's funny. Like now, there's now a generation of people that work in trading and investment management that didn't experience that, right? Like they just, float more around. It's not in their Overton window.
Right.
Right. So people are like, oh, the market moved 1%. I'm still at 1%. Like you're showing your age. But they had Corey. So this is what it was like as an anecdote, right? Market's down 2% before the open. You can't it's at 8:15, the phone's ringing off the hook. Okay. And the options market doesn't open until 9:30. Right. And you can't leave the desk. It was just misery. Right. And I was hunched over a garbage can eating a muffin because they crumble. I didn't want it on the desk. I'm hunched over this garbage can eating a muffin, just like trying to have a little semblance of peace before the onslaught started, right, for the day. And Ed Corey, who sat next to me, turns to me and looks and goes, "Is this what you thought you'd be doing after business school, buddy?" he's like, here he's out, big math guy came in here, thought you're going to cover big, because you're hunched over a garbage can, waiting for today's, slaughter of people trying to buy puts, and, and somehow get some short exposure. So that's what it was like. But I mean, it was psychologically intense. At one point, there's so many funny little anecdotes I could tell. Like at one point, we had a guy, Lars, who traded the financials book.
Oh God.
He was on the phone with E-Trade trying to transfer out of his own money from E-Trade to another bank while clients were calling in trying to buy puts on E-Trade.
He's not conflicted at all. He's fine.
He's on the phone trying to get like assets out.
Get me out the door.
While a directional hedge fund, and this one I don't want to say it. We had a couple pretty sharp accounts, right? And so when these guys start like buying and rolling down puts, it was like, get out of the way, right? Because like he's been right now 3 names in a row, right? And now he's calling and asking for E-Trade. And it's like, oh, right. Like really, like E-Trade's going down. I mean, E-Trade didn't go down, but, yeah, literally while the guy who trades the book is trying to get his own money off the custody platform, he's being asked for a market on, 2,000 2-month at the money puts. So I mean, it was intense, right? And you didn't, there was a lot of vol. Now mercifully, and this might seem counterintuitive, like the business wasn't as restricted then as it is now, right? So you could take a lot more risk. All right. And there was more opportunity for the trading desk to take risk in that environment, because at this point, the CCAR, Basel III, balance sheet charges, like all this stuff doesn't exist yet. Right. So, and this is actually one of the things we talk about. I don't want to go too technical in this podcast, but the options market microstructure has changed a lot over my career. And this is the defining moment, right? This financial crisis. Because after the financial crisis, the regulations change, and the way that implied volatility used to change as the market moves around and as the macro data moves around is completely different now than it was when I first started. And it's all about the fact that banks and a handful of marginal risk takers aren't in the market anymore because they were basically regulated out of taking that risk. So, yeah, I mean, it was an intense time, and you didn't really know. I mean, your clients, like over any 3-month period, your client list could completely turn over. Like people go out of business, right? Or, one long vol guy is making a ton of money, and then 6 months later, because he doubled and tripled down, he's gone, right? The structured products are all doing weird things that we never expected. Regional banks are like, their structured product books are blowing up. It was like every day there was a mid-sized to large-sized fire of some variety, right? And then the Fed gets involved, and try with the Lehman and Bear Stearns stuff. And I remember at one point we get asked to come in on a Sunday because the Fed had this idea that we were going to like net over-the-counter positions together, so that there would like be less outstanding stuff in the wake of all this volatility. Zero trades happen, right? Except for the inquiry that we got where another bank, who will remain nameless, asked us. They were like, well, what I really need is if the market goes down 10%, I need to be, short all this stuff. And if the market goes up 10%, I need to be long all this stuff. We're like, buddy, yeah, okay. You and everybody else. Like, so there was no map for any of this, right?
But you're
just kind of had to take it one trade and one client at a time.
Okay, that specifically, one trade, one client at a time. And you've done the sales route. You're managing these relationships in the sense of you're forming these relationships with all these parties who are calling in on the phone and doing trades with you guys and whatever else. I feel like that crisis had to shape the way you learned to think through what other people were trying to do, accomplish, express. Was that pivotal in your learning?
Yeah, for sure. derivative investing, what we do at Convexitas, is entirely about understanding the flows and biases in derivative markets, and then using those, right, to create trades and strategies. So at least that's what derivative investing should be. I mean, the reality is now I own a business that is focused on the wealth channel. It's not wealth, options and wealth isn't really about that. It's about people just kind of buying payoffs, right? There's not a lot of people out there doing actual derivative investing. I mean, it's kind of part of why we started Convexitas, which is this idea that you can start from the biases, actual value in options markets, and build strategies that start from those edges, and then you can make things that are useful to financial advisors out of them. That's what we do at Convexitas. But that comes entirely from being on the desk and understanding what all these different parties are doing. So equity options are unique among all of the asset classes, and it's really the only derivative option class that has every player. Okay, so retail, hedge funds, all the different kinds of hedge funds, asset managers, sovereigns, family offices, insurance, right? It's one of the few asset classes that actually has every possible investor in it, all doing different things at different times for different reasons, right? Some driven by statutory needs and sometimes not. So the education that you get from watching that, right? So we'll get clients ask us, how does your risk mitigation strategy compare to the traditional tail risk funds? Like, I'm not answering that question as a theoretical. I used to take the orders, right? Like, I know exactly.
They called me on their worst day and on their best day,
exactly.
But both of those. Yeah,
exactly. So, I think, understand, I didn't finish my career on the flow desk. I finished my career in the structured product world, and what we call the solutions business. But spending the first half of my time on Wall Street on the flow desk, actually seeing why are the insurance companies doing this? Why are the macro hedge funds doing this? Why are the asset managers buying these puts? What are all the different shapes of variable annuity hedges that show up in the market, and why does that matter? Like, how those things actually go from trades to dislocations and biases in option prices. That's the fundamental education of being an options investor. So, and I got to see it through multiple crises. I mean, I joked with people that my whole career, all I've done is lurch from one crisis to another, right? Like, startup internet company. I worked at Lycos, which ultimately I was gone by the time it happened, but that went down for the dirt nap, right? To Google. Then the company I went back to went through this wild bankruptcy and restructuring. And then I show up on the desk at, as a 26-year-old. And then 2 years later, we have the financial crisis. And then 2 years after that, the European sovereign debt crisis, right? And then they've been kind of de-escalating magnitude since then. But, my whole experience with work and financial markets has been marked by these types of, failures, kind of large scale business failures. But the difference is now I kind of look at it through the lens of these option prices and what we're kind of seeing in the prices of puts and calls. And, is there something to be learned from that? Or is there a strategy to be made from those dislocations and flows? So, I think it's made me who I am as a guy that owns a financial, investment business.
All right. Take me back to, let's go to Bad Bank. Tell me the Bad Bank story. How do you get slotted into the seat? What's the experience? I mean, this is unique and interesting.
A bad bank is the opposite of a trading desk. So when you have a trading desk, you get a budget and it's amount of money that you're supposed to make. Okay. In a bad bank, you get a budget and it's the amount of money you're supposed to not lose more than in the process of disposing of the assets that you are in charge of. So I spent the first half basically of my time in the equity derivatives business as in the flow facilitation business, clients calling us up wanting to do blocks of option trades. I spent the second half of it in the structured products business, where I ultimately was the head of solutions, which was basically the structured salespeople and the structuring desk itself. So that's like, the structured note business where we were a wholesale participant, the investable index business, the over-the-counter light exotics business, and the fund derivatives business, which is like if you want a non-recourse loan against an alternative asset, right? We would underwrite those. Or we had this really interesting investment platform called VB Select, where you could get a swap on like a portfolio of funds if they were onboarded onto the platform, right? So there's, but these are all derivatives based on funds rather than stocks and indices. So as part of that, we had all of this kind of complex stuff, right? So July of 2019, Deutsche Bank decides it's exiting global equities, which was a shame. Our business was good. It was one of the better businesses in equities, but and along with prime brokerage, but unfortunately, overall, it just didn't make sense. And I think that's largely driven by the first factor is trading desk makes money on flow. Okay. So as a foreign bank in the United States in equities, you're competing for flow against the US banks, which, frankly, have bigger and more important relationships with US clients, right? So you hear this phrase, well, we have to pay, right? Like if you're XYZ big asset manager and you have a wallet of, you have so many trades you're going to do over the course of a year, there's an amount of business, just to kind of like keep things balanced, there's an amount of business you have to do with Bank of America, with Goldman, with, whoever your partners are. So I mean, not comically, sadly, but I remember one year, this would have been in early 2018. Or no, I'm sorry. No. It was my last year on the flow desk. I remember this was kind of one of the reasons I got out of the flow business was it was in the spring. It was like May. Okay. And within a span of like 3 weeks, half of my clients called me and said, we love you, but we can't do any more business with you because we're doing too much business with Deutsche Bank. It has nothing to do with you, but we only have so much wallet to go around, and you've been getting it because we like the service you're providing. They're like, but we got to catch up these other people. So I lost like half my clients in the span of 3 weeks. Now that year turned out to be like a lower volume year, which is why that was the year it happened. That sent a pretty clear message to me that like the wallet for flow, for institutional block facilitation was shrinking, right? So that's why all these people are kind of being shown the door in these trading seats, right? The number of people that you need, the amount of wallet and flow out there is just decreasing over time, right? When I started in that world, we used to have long, short hedge funds calling us up doing discretionary option trades 5-6 times a day. By the time I was done in the flow business, that wasn't the thing. The strategies that were successful were risk arb, credit arb, stat arb, right? These aren't strategies where you're making discretionary options trades, directional options trades, right? That business was just kind of gone. Wallet got smaller. And those people that had those jobs were decamping to family offices and different types of institutions. So that's forever changed the amount of opportunity out there. And ultimately the foreign banks, I think felt that first. So Deutsche exits the market. And basically I get the option of staying on and working in the fixed income role or or sticking around in the the bad bank and helping it to dispose the business. Because I mean, like I was the head of the structuring desk. So like we had all this stuff that needed to get gone, some of which you couldn't auction off. You had to negotiate out of bilaterally, and it's complicated, and distribution relationships for structured products and these sorts of things. So, but the real thing was, I was about to turn 40. And I was looking at it going, do I want to spend another 10 years plus, kind of just doing the same thing in a fixed income role? I was starting to get that itch that it was like time for something else. Didn't really have anything to do with Deutsche Bank, but I just wanted to do the next thing. And, my co-founder, Zed, was in a similar place at his job at the time. And, we started talking about, well, it was a little bit later than this, but we're both kind of thinking about what's an interesting financial services business that doesn't exist that we think we could create. So I decided to take the bad bank route, to kind of come off the production treadmill, so to speak. And it's a totally weird experience. I mean, it's basically a trading desk on its head, where instead of trying to facilitate trades, you're trying to get rid of trades. So you take the book and the flow books, and you chop them up into the most neutral risk possible auction blocks you can find, and you auction the risk off. And then you have to go through this big long novation procedure to actually get the contracts that were over the counter, no longer facing you, facing the person that bought the risk. So we went on, that process took 8-9 months to get rid of all that. All the meanwhile, I'm working on the background and getting rid of our complex exposures and our complex distribution relationships, and which I was successful at. So somewhere around 10 months, there wasn't anything left. Like the risk in the book was actually zero, right? And there was some legal tag ends and some stuff that has to get tied up. But I mean, you literally get to the point where there are no more trades, right? And then your time in the bad bank is done, and you're politely show the door.
Congratulations. You emptied out the storage unit. Now, if you could just sweep the floor and move along,
yeah. But literally, there was 3 more people that stayed longer than I did. But I mean, I'm actually just coincidentally, I'm going to see the guy that like literally turned the lights out. I mean, that old joke, turn the lights on your way out. I mean, the guy that literally turned the lights on, I'm going to see him for breakfast on Friday. But yeah, I mean, I saw the actual end of a trading business, like what it looks like to go all the way to zero. So that it's an interesting experience. And like, I actually thought maybe one of the things that I could do is start like a professional bad bank team, because the process of doing all this is actually really very detail oriented. So you've got to take assets, you got to move them into the bad bank, and there's all kinds of regulatory stuff around that and accounting for that, because the regulators rightfully don't want you doing stuff like, oh, here, I'll jam my bad trades in the bad bank, I'll take the good stuff, right? Like there's all kinds of potential games that could be played around that you got to be careful that you're documenting, and you got to run these auctions transparently and fairly. And then you got to run a sane novation process, which is actually my specialty. But the details of all of this are actually really intricate, right? So I thought, well, maybe, I told you my view, like foreign banks are going to be exiting these businesses, as by the way, they continue to have. So there's going to be bad banking needs. Like, maybe there's a bad bank consulting business here to be done, but ultimately I decided that there's a weird thing that happens. Most people, they go to work like they're building a business, right? Like it's a constructive process. The bad bank is a destructive process. I mean, you could think of it as a purging of the forest, right? So that new things can grow. So that it has a long-term constructive aspect, but it's locally a destructive process. And I think it has a bit of a wear on you that's different than going to work every day building something. And by the end of my 18 months or so in the bad banks, like I didn't want to be a professional bad banker, right? I wanted to have a locally constructive job instead of a destructive one. So that's kind of where the Convexitas story begins, and Zed and I, who Zed was kind of already in motion, and
Tell the story of
how
did you meet Zed? Because I don't know the story.
He was one of my very first clients in 2006 on the flow desk. So he were about the same age. He had a parallel career on the buy side, and he was working at a hedge fund that got assigned to me as like literally I'm an associate. I mean, it might have been my second client or my third client, like one of my very earliest clients. He gets assigned to me, and we had a 15, 16-year relationship before we started Convexitas together. So I grew up from associate to managing director at a bank, and he went through a series of investment management jobs, from hedge funds to asset managers to actually a couple different kinds of asset managers to even other retail businesses. So we kind of had parallel careers, and then we both were free at about the same time, and went, wouldn't it be interesting if we could take what we consider to be high quality options trading and what we think is the good stuff from the institutional world and find a way to deliver it into wealth, which is a much bigger green field of opportunity as an entrepreneur, right? Rather than trying to start a hedge fund or an institutional oriented business, trying to sell a fund to, primarily pensions and a handful of family offices, right? So wealth is just a far more interesting opportunity. I looked at it as a derivatives person, I thought there was a huge space to do more interesting product. As a technologist, I thought there was a huge opportunity to use the technology tools that I had to essentially build the platform that you needed to do the interesting product, right? Because that was really the thing. In wealth, it ultimately comes down to, can you manage large scale SMAs, right? Hedge funds don't want to do SMAs because they're a huge pain in the butt, right? Like tracking the positions and the P&L and the risk and the reconciliations, rather than once or twice because you have one or two funds, having to do it hundreds or potentially thousands of times, those tools just don't exist, right? So I looked at it and went, and Zed had experience with this world, and he's writing out for me, what, if we were going to do it properly, not on spreadsheets and nonsense, but if we were actually going to have databases and tools and an actual back end running the business, what would that look like? So he's mapping it out for me, and I'm like, look, it's tough, but this is actually doable if the guy writing the code understands derivatives, understands operations, and knows the technology pieces, right? Which that was a skill set I had. So we're an investment management firm first, but that investment management firm doesn't exist without an extremely unique piece of technology to manage SMAs at scale that honestly, I never would have had the wherewithal to even understand it, let alone write the code for, had I not had the career that I did in technology before I went to business school. So, it's a weird way of stuff coming together. We were able to start this business with two people, I think, because I was able to do the technology and the legal and the compliance, kind of, all the stuff that I learned while I was in a senior role at Deutsche Bank. I think starting this firm would have been a 4 to 6 person job otherwise, because you would have had to have developers and a separate compliance person, and it just would have been much, much harder to achieve, the level of strategy sophistication that we've been able to in just 3 years.
What does, and to the degree that it has an impact, what's COVID do to the business, to the career?
Oh yeah, that's a fascinating question. So I will go so far as to say that we don't exist without COVID. We wouldn't have made it off the ground.
Because you were
we were starting the business. Yes, that's right. Yeah. So so two kind of things happens because of COVID that we would just I don't think we would have been able to achieve liftoff quite as easily or at all. And the first is every lawyer, creative person, marketing person, like if you think about all the stuff you need to get this business off the ground, like I need all the formation work done. I need marketing, pitch books, branding, websites, right down to the business cards. Well, I guess people don't use business cards anymore. Young people think it's funny that I have business cards. But all the stuff that you need to start this business was basically on a 50% off sale when we were starting this business, right? I look back now and I can't believe what we paid for, our first compliance consult, our first round of the website and creative work, all the formation and legal. I mean, we were paid $400 an hour for like senior securities counsel work. Incredible, right? I mean, not in New York and Chicago, but
Still,
yeah, incredible, right?
Right.
I mean, it's $750 now, for those guys, right? So, from a cost perspective, I'm not sure we could have started this. Well, we could have started this with a cost loan. And when you're writing a check, it matters. But the second thing, and possibly the more important thing, is the amount of due diligence that we were able to do with our early investors via Zoom was a total game changer. Like, we were able to do way more calls, scale way faster on the marketing side, because people were willing to talk to us on Zoom. They were already conditioned to do it.
When people want to talk to you like this, and you don't have to get on a plane to do sales, that's a massive jump.
So we may not exist at all, frankly, without those two things coming together. It would have cost us a lot more, and it would have been a lot harder to get through the early hurdles. So part of our business is, we have to be on these platforms. We have to be on Schwab, Fidelity, Pershing, Interactive Brokers. And there's an amount of due diligence that has to get done with all of these people. And then RIA platforms, that's another layer of due diligence, right? Like the idea that we were going to do that not on Zoom, right? Like we had a Mercer Sentinel ODD via Zoom, unheard of prior to COVID.
Not an option. Yeah. You were on a,
so, much, it's a sad thing for society, but was probably critical to the formation of our business.
Well, luck is an occasional thing to do it. I got a ton of notes. I want to take you back through some of this because I've got some follow-up questions. First and foremost, do you want to guess birth order? Can you guess what birth order I am? Where do you think
you are?
Yeah.
I don't know you that well yet. We've only had a kind of long phone call and this. And
me listening to you talk. So you've got little judgment here. But let's hear what we got. How do you analyze this?
You're a little too inquisitive and interested in other people to be a firstborn. I don't like firstborn for you for that reason. But you work like a firstborn. You have 7 jobs. So that the first thing I would do is I would decide if you're firstborn or not, because then it's easier to do the other ones. So I'm struggling with the firstborn decision with you, but based on personality, I just don't think you're not sharp. You're not sharp interpersonally like most firstborn. So I'm going to say you're not a firstborn. Am I right?
No, I'm firstborn.
That's
okay.
Stop. Maybe with more time, I would have gotten there. Right?
With more time and you actually on the other side of this, you probably would have gotten there, but it's really interesting. I'm the same way with this. My wife and I, we talk about this a lot because we're both firstborns, and even my youngest brother.
No. Firstborns marry other firstborn. Okay. My wife is a firstborn. They're different toothpaste. Okay.
Right.
She has her toothpaste, I have my toothpaste. Okay. The firstborns marry other firstborns. Dude, we understand each other.
It's the only way for this to work. My brother, the quote unquote baby, the 3 of 3, he's married to another 3 of 3. And it's the same thing. We get together. We're all like, this is all so weird for us to cross-examine each other.
Yeah. You do work like a firstborn though. You have like 4 podcasts. You have an advisor business. I don't know when you have time to do that, but that's a big indicator. But that was a thing put me on the fence. But
well, you nailed that. The sense of over responsibility and loyalty to too many things at once is it's very, very real. I love this idea of the Boy Scout thing. For some reason, I'm so happy to know this detail, because there's something about that attention to the environment and detail in the environment and getting tasks done that I think I was never a Boy Scout. And I think about the Eagle Scouts, and I would have put money on you as an Eagle Scout too, after you said this.
Well, I mean, look, I took too long. I got sidetracked, but it's an amazing program. It's changed a lot, just due to what's happened. And it's not a little unfair. It's a lot unfair to a lot of great people that put a lot of work in it. Being a Scoutmaster I used to say, well, I use the word externality now, but I used to say that being a Scoutmaster is always an accident. Okay. There's always something going on in that person's life that is extremely unusual that lets them be a great Scoutmaster, right? There's some reason why they have enough time to be able to dedicate to doing. Okay. Ours was a little bit of a sad story. This guy, Ken Wyand, he's amazing. I mean, could not have had a bigger impact on me as a young person. Okay. But unfortunately, Kenny was in a hunting accident, so he was on disability. But what it let him do was run the troop, right? And that's why my troop was so amazing, right? Was because there was a person that could do it, right? And it's such a huge commitment, right? To organize the campouts and all the gear, and he had a whole shed in the back of his backyard that was nothing but Troop 569 stuff, right? And the trips and the cooking outside and the backpacking and the accidents that would happen and the crap that you would forget, and the experience of being out in these junior leader training camps for a week, and it was incredible, leadership and independence shaping thing for me. I loved it, but
you can tell it's carried through and across. I also love this idea of from high school into college, like the Lycos stuff, the experience of college and working at the same time. I think there's something really important about that, of people who are willing to lean into that at a young age, who are just like, I don't need this other traditional path. So you were never bothered by having a traditional college experience, like while you're having it?
I will say that, well, first of all, I mean, from the time I was 16 to the time that I graduated graduate school, I was working and going to school with no breaks, right?
Full-time stack.
The Stargate. So I graduated undergrad in December, and then the Stargate bankruptcy thing happened the next spring. So I didn't even get a break then. I was like, the Stargate bankruptcy put me right back into school. So I went like a 10-year period of my life where I just worked my ass off, like all the time. So now I will say that I wasn't, kind of for my senior year in high school, particularly, I got plenty of partying out of my system.
Sure.
I had older friends that were already in college. You could fill in the blanks. Like, I kind of got it out early so that by the time it wasn't my plan, it's just the way it worked out. But like, by the time I got college and I had this cool job, and the other thing is, you start to like having money.
Yeah.
Okay. So my first job, I was 14 years old. I was working at a gun range, a sporting clay course. So as a 14-year-old, and this is basically like this was back in the time you would sit on the trap machines and they had to be manually operated. Today it's all push buttons. But at that point, a person sat on a machine and loaded in, hit a button and released the targets, right? It's a moving target. So if I could take 2 groups out, 4 people in each group, I could be walking out of there as a 14-year-old with $100 to $120 a day. Right. So like I learned early that you could work and get money and do things. Right. So I was perfectly happy to have a cool job and have some cash. And yeah, that meant that, I remember in college more than under my graduate degree, but I'd have to do a one-nighter a couple times or an all-nighter a couple times a month to get everything caught up. But I continually judged it worth the price.
These are the skills you learn, and it's interesting inside of that too, because I think you're learning there's different values assigned to different jobs, and that connects. I know it. I think it felt to you like a tangent in real time, but I really think it fit really well when you're talking about learning like the values of stories alone versus the value of cash flows and operations and building these things, and understanding there's a lot of layers towards what different jobs and roles and responsibilities are worth to different people at different times. It's a really nuanced lesson you were learning pieces of way before you even learned it the hard way.
Yeah, but I think that's right.
Yeah,
I think that's right.
What do you think? I wanted to ask you too about just growing too fast. Like did you're Pittsburgh prudent? You're paying the loans when it's the forbearance, and you're not the first to default. What is it about, like with Convexitas, you don't want to grow you have an awareness of the speed that you want this business to grow. What is it?
Yeah. Boy, I mean, you talk about something that gives me, heartburn on a weekly basis, or at least not heartburn, but I spend time thinking about it every week. So I think that there's an element of safety. Like we want to grow things safely. Okay. When it was just Zed and I, it was a little less important. Zed and I both had successful careers. We both had some money, not like we're going to sail off into the sunset retirement money, but we had enough money to start a business and be comfortable and not, still I could still go out to dinner, right? While we were starting the business, right? Not eating ramen noodles. But then what happens is you start hiring people. Okay. And I will say that I think I think entrepreneurs are a little too casual with what that means. So these people that work for you, okay, there's a lot of reasons why they work for you instead of having their own business or doing something, right? Or working in a big company, right? But, Zed and I feel like, we have a responsibility to Will and Brian not to blow this up. Because it's about more than just Convexitas. It's about their lives too. I mean, I don't mean to get too serious here, but I know hedge funds that have failed and their employees have committed suicide, right? Because they didn't know what they were going to do next. Now, I'm not saying anyone at Convexitas is that their mental health is that tied up and going to work for us.
But it's a real responsibility to care for other people when you start a business. That's what you're doing.
Yeah. You have a responsibility to the people that work for you. And I think that gets lost kind of on a couple dimensions. In a big firm, no one really, it feels like you never know where the money's coming from, right? Like, and even if you're like local small business isn't doing awesome, like people are still getting paid, right? And I also think to the entrepreneurs, you get used to a certain level of risk, right? And you kind of forget that maybe the people that work for you aren't signed up for that level of risk, in terms of, what their income is going to look like year over year, but especially younger people, right? Or people in you get in your 30s and you have a couple kids, right? Like, you have real responsibilities. So,
changes the risk appetite. It really does.
This is a long way of me saying, I think we're very concerned about safely growing. Like there's a part of me that would like to have a big pile of cash so that we could go out and build like a huge distribution arm, right? And instead of having 1 or 2 great due diligence meetings a week, we're having 10, right? But it's not obvious to me that for the amount of money that it would take to do that, like we would really be guaranteeing the result, frankly, and it would, it put the whole thing in jeopardy, right? So we could go get we could do it with investors' money, right? But then now we're selling, what I think is a very high operational leverage business and what stands to be a very profitable business. We're selling it at, even if you sell it at a good multiple, you're just kind of selling it at a low absolute dollar price, right? To get that opportunity to grow. And like, I as an owner, like I struggle with, how much equity we would have to give up to get that shot, right? And that's what I mean about, I think you meet kind of two kinds of entrepreneurs. You meet entrepreneurs that talk about their business as, I have these investors and this number of employees. And then you meet entrepreneurs that say, I have these clients and this amount of money, right? And I think Zed and I want to really be in the second camp. And has it cost us some growth rate at times? I mean, I think so, but at the same time, like everyone's safe, right? And I think that like we will have a bigger distribution team later, right? Which will benefit both from the firm's maturity as well as our maturity in being able to tell our message, and be able to, articulate our value, right? But, you certainly see plenty of, fintech, particularly the fintech guys. Like when you come from the technology world, right? I think there's that there's that desire to like raise money, try to be disruptive, right? And have really big ideas and try and execute on them. I think that's kind of where people go first when they come from that world. And I don't want to name names, but like we see the results, right? And the reality is, I think scaling a business like ours, particularly a business like ours, where we're asking people to look at our option strategies and understand that it's much different than anything they've seen before in the options world, right? This isn't concentrated stock and overwriting and trading callers on a treadmill. We're offering people kind of real high investment merit, institutional quality strategies in wealth, and in some cases for the first time. And getting people to understand that is a real kind of journey that they've got to get their mind around. And I don't think Zed and I have been able to say, well, we think that even if we had a big team, that ramp is X and it's going to cost this amount of money. Like, I don't think I have that clarity. So, that's how we've balanced it. And for better or worse, I saw on LinkedIn recently, it was a fake deal tombstone. And it was like, business crosses X amount of free cash flow, no Series A financing.
Oh God.
And I was like, okay, like I get it. Listen, my heart goes out to you, buddy.
Right.
But maybe a little too intense, but it's just another way. And I think, well, it's not another way. That style of managing and growing your business, I don't think gets celebrated in the way that the raise a bunch of money and potentially burn it up does, because it just looks less spectacular.
Spoken like a man who still carries around business cards. Devin Anderson.
Yeah, right, exactly. Yeah, take your business cards and go back to doing business in 1999.
Right. Leave it in the fishbowl at your local restaurant. People want to find more. They want to read about Convexitas. They want to bug you on the internet. Where should they look you up these days, Devin?
So you can go to the website, www.convexitas.com. We're all over LinkedIn. Reach out to me on LinkedIn. We have a company page on LinkedIn. We put a lot of content out there about macro, about derivatives. We have webinars usually every month. We've got, this will be published after. We got one coming out tomorrow, actually. But we got webinars every month that you can use to learn about us. We're at kind of major wealth conferences, either as a sponsor or participant. So you're going to be able to find me pretty easily on one of those venues.
Make sure you look him up. Now that you got the full backstory, Devin Anderson, you are truly an intentional investor. I want to thank you for joining me today.
Thanks a lot, Matt. It was a lot of fun.
Thanks for tuning in. Be sure to like, share, and subscribe wherever you're watching The Intentional Investor so more people can find our show. You can follow Matt directly at cultishcreative.com or at cultishcreative on Twitter. For more great content at the intersection of investing and life, check out epsilontheory.com or at epsilontheory on Twitter.